Hello friends. So in my previous two videos, we have started with the dividend discount model in business valuations. Alright, where we have already understood that how to find the intrinsic value for a particular stock and how to find the expected return, which means nothing but the cost of equity for a particular stock. Alright. Now in this video, after having learned how to find the intrinsic value and expected return for a stock, we will now compare both of these variables. So what we will do is we'll compare the intrinsic value with the market price and build a suggestion of whether we should buy a stock, we should sell a stock, or we should hold a neutral position. All right. So this session is particularly focused on the comparisons. Okay. So I'm assuming that you're very well averse of how to find intrinsic value and how to find the expected return, which is nothing but the cost of equity for a particular stock. Okay, my dear friends. Fine. So I will share an Excel sheet with you all. So just pay attention to that. So here we go. Yes. So now observe the question very nicely, my dear friends. The question says that the next year dividend, sorry, this T is missing over here. Okay. So the next year's dividend is $3. The market price of a stock is assumed to be $100. The expected growth rate, which means the G factor, is equals to 4%. The expected return is assumed as 10%. All right. Now, these are the given information in front of us in the question. Now, what we will do is we will find the intrinsic value, means we will find the intrinsic price of a stock at a growth rate of 10%. All right. Because we are expecting a return of 10% on this stock. Fine, my dear friends. Fine. So, what I will do is I will use the formula of intrinsic value. And in my previous videos, I have already explained you how to use the formula of intrinsic value. So what I will do is I will just repeat once again for the sake of your convenience. So I press is equals to over here. The formula of intrinsic value is nothing but next year's dividend upon the expected return minus the growth rate. So in this question, the next year's dividend is $3. So I'll plug this $3 over here, put upon sign, upon it is what expected return minus the growth rate. So expected return is nothing but 10% minus the growth rate is 4%. All right. So I press enter over now. I get the answer as $50. So my dear friends, if we are expecting the return of 10%, then the intrinsic value of a stock at the expected return of 10% should be $50. Right, my dear friends? I repeat once again. If you are expecting a return of 10% on a particular stock, then the intrinsic price of that stock would be $50. Right, my dear friends? Friends, in a market, there are different type of investors who expect different type of returns from a stock. All right. While there might be someone who will be expecting a return of 10% as given in the question over here, but some might expect a return from a stock ranging anywhere from between 5% to the 17%. All right. So now our job is to find the intrinsic value for that particular expected returns of a stock. Okay, my dear friends. Fine. So what we will do is we will use the data table in this ribbon tab and we will use what if analysis. And we have learned how to use this what if analysis earlier. But for your sake of simplicity, I will perform the steps once again. So please observe over here. So what I do is I delete all this part. Okay. Because this is what we have to find. Fine. Now what I do is I start linking. So what I do is I go back to the question and I find those things which I already find out and which are already available in the question. Okay. Now it is given that the expected return of a stock is 10%. And when the expected return of a stock is 10%, my dear friends, the intrinsic value that we got is $50. Okay. So these are the inputs from the question. I repeat, my dear friends, these are the inputs. Okay. So the first input is that the expected return is how much? It is 10%. So we write 10 over here. All right. And when we are assuming the expected return to be 10%, we write is equals to the intrinsic value will be equals to how much? It will be equal to $50. Right, my dear friends? Fine. So now what I do is I select both of this part, drag it down, and I go on to the ribbon, click on data, select what if analysis, click on the data table, and in the column input cell, since we are dealing with this one dimensional column, we will select that value which is originally available in the question. Okay. So the original source of data from the question is the expected return, which we assumed to be 10% in the question. Okay. So I press 10% over here and I press OK. Right, my dear friends? Fine. So after pressing OK, what I get is directly the figures that the intrinsic value for a particular stock at a particular given expected return rate would be this. Okay, my dear friends? Fine. So now I have to make recommendations. And how will I make recommendations? By comparing. And by comparing what? Two things. Which are those two things? The first one is called as the intrinsic value. And the second one is, yes, second one is called as the market price. So let's start comparing now. If if the market price of a stock currently is $100, look at my cursor, my dear friends. If the market price of a stock is $100, then at a 5% expected return, your intrinsic price would be $300. Okay, my dear friends. So आपको पता चल गया है कि मार्केट प्राइस अभी काफी लो है, जबकि वो बहुत बढ़ सकता है. It can increase to $300. So what you will do? You will buy the stock. So we recommend a strong buy in this position. Right, my dear friends? Fine. Similarly, your market price of a stock is $100, but if you are expecting a rate of return at 6%, then the intrinsic value that you will get is equals to $150. Right, my dear friends? Now, obviously, this intrinsic value of $150 is greater than the current market price of $100, which means there is a future scope that the market price would increase. Okay, so for that purpose, what we will do is we'll put a strong buy position. We'll go long on this position. हम लोग buy करेंगे stock को. Okay, my dear friends. Now, similarly, we can interpret all these numbers. I will just help you with one more number where if the expected return is 10%, we get the intrinsic price of a stock as $50. But the current market price of a stock is $100, which indicates that your future price would move downwards. And for that purpose, what we will do is we will recommend a sell position. Short कर देंगे, हम लोग निकाल देंगे वो stock को अपने portfolio से. We'll recommend a sell position. Okay, my dear friends? Fine. So this was all about the dividend discount model, where we understood how to compare the two variables. The first one is intrinsic value and the second one is the current market price of a share. I hope you are clear with the concepts. Right. Thank you very much.